Every financial asset you own depends on someone else keeping their promise. Your bank account is a promise the bank will return your money. Your stock is a promise the company will maintain value. Your bond is a promise the government will pay you back. Even your cryptocurrency runs on a promise that the network stays honest. Every single one requires trust in a counterparty. And when crises hit, that trust breaks, always. In 2008, Lehman Brothers was the fourth largest investment bank in America. It held $639 billion in assets. Investors trusted it. Regulators cleared it. Rating agencies gave it investment grade status. Then it collapsed in a weekend. Every promise it made became worthless overnight. Stock went to zero. Bonds defaulted. Counterparties scrambled. The entire global financial system seized because the trust holding it together evaporated. What saved people in 2008 wasn't diversification across stocks and bonds. Everyone holding those lost. What saved people was the thing that required no counterparty: physical gold. While Lehman creditors fought in bankruptcy court for pennies on the dollar, gold went from $800 to $900. It didn't rally because someone promised it would. It rallied because it promised nothing. It just existed. No CEO to trust, no government to believe, no network to validate. This is the pattern that repeats through every financial collapse in history. And it's happening again right now in 2026. If you're watching the current crisis and wondering why gold keeps breaking records, stay with me. Because what you're seeing isn't just a rally. It's the market realizing that every counterparty it trusted might fail at once. The entire modern financial system is built on counterparty chains. You deposit money in a bank, the bank lends it to a business, the business issues bonds. An insurance company buys the bonds, a pension fund invests in the insurance company. Your retirement depends on that chain. And every link in that chain is a promise. In stable times, those promises feel solid. Banks seem permanent, governments seem reliable, corporations seem durable. The chain holds. But in crisis, the chain doesn't weaken gradually, it snaps. One counterparty fails, the next one can't pay. The cascade begins. And by the time you realize the chain is breaking, it's too late to get out. This is what happened in 1929. Banks across America held deposits backed by stock market loans. When stocks crashed, the loans defaulted. When loans defaulted, banks couldn't return deposits. When banks failed, depositors lost everything. The counterparty chain collapsed, link by link. People who thought their money was safe discovered it was just a promise. And promises don't feed families. The same pattern played out in Weimar Germany in the 1920s. The government issued bonds to finance war reparations. Citizens bought those bonds believing the state would honor them. Then inflation spiraled. The currency collapsed. The bonds became worthless. Savings evaporated. An entire generation learned that government promises are only good until they're not. Argentina repeated the lesson in 2001. Banks froze deposits. The peso collapsed. Bonds defaulted. Middle-class families who had trusted the system watched their life savings vanish. The counterparty they relied on, the Argentine state, simply stopped honoring its promises. And there was nothing depositors could do. The promise was gone. In 2013, Cyprus did the same thing. Banks were insolvent. The government needed a bailout. So they confiscated deposits over 100,000 euros, took them, just reached into accounts and seized the money. People woke up to find their balances reduced overnight. The counterparty risk everyone assumed was theoretical became real. And it happened in Europe, in a modern banking system, in peacetime. Then came 2020. Lebanon's banks locked their doors. Citizens couldn't withdraw their own money. The Lebanese pound lost over 90% of its value. A lifetime of savings became pocket change. The banks, the government, the entire financial infrastructure, all of it failed simultaneously. The counterparty chain didn't just break, it disintegrated. Notice the pattern. In every case, people believed their assets were safe. They trusted banks, they trusted governments, they trusted the system, and in every case, that trust was betrayed. Not because of evil intent, because the counterparty couldn't keep the promise when pressure mounted. Now look at 2026. Banks are stable for now. Governments are solvent on paper. Markets function. But the pressure is building. War in the Middle East. Oil choke points threatened. Inflation persistent. Debt levels unprecedented. And every day, the counterparty chains get more fragile. Your bank holds treasury bonds as reserves. Those bonds are promises from a government running trillion-dollar deficits. Your stock portfolio depends on companies that borrow to buy back shares. Your pension relies on insurance companies that invest in commercial real estate. Every link is a counterparty. Every counterparty is making promises. And those promises assume stability. What happens when oil hits $150, when inflation surges, when debt becomes unsustainable? The promises don't adjust gradually. They break suddenly. Banks can't honor withdrawals. Bonds can't pay interest. Stocks can't maintain buybacks. Pensions can't meet obligations. The chain snaps. This is why gold moves differently than every other asset during crises. Stocks need companies to perform. Bonds need governments to pay. Real estate needs buyers with credit. Crypto needs network consensus. Gold needs nothing. It has no counterparty. It makes no promises. It simply is. When Lehman collapsed, shareholders needed the company to survive. It didn't. When Argentina defaulted, bondholders needed the government to pay. It didn't. When Cyprus confiscated deposits, account holders needed banks to honor balances. They didn't. But gold holders in every crisis needed nothing from anyone. They held metal. The metal had value, no promise required. This is the core difference that most people miss. Diversification across assets that all depend on counterparties is not real diversification. Holding stocks, bonds, and cash in a bank is 3 different promises from 3 different counterparties. But they're still promises. And in a systemic crisis, all promises fail together. Real diversification is holding something that requires no counterparty at all. Something that doesn't depend on a bank staying solvent, or a government staying honest, or a company staying profitable, or a network staying secure. Gold and silver are the only widely held assets that meet this test. Look at what's happening in 2026. Geopolitical risk is spiking. Defense systems are failing. Oil infrastructure is threatened. Embassies are burning. Every day brings new evidence that the assumptions holding the system together might be wrong. And every time those assumptions crack, counterparty risk increases. When Iran's hypersonic missile defeated Israel's best defense system, it didn't just prove the missile works. It proved the promise of protection was wrong. Countries that bought those defense systems were sold a promise. The promise failed. Now they're recalculating every security assumption they made. And recalculating means repricing risk. When a $2,000 drone destroyed a $1.1 billion radar, it proved the promise of technological superiority was wrong. American military dominance is a promise. That promise just got questioned. Allies who depend on that promise are now hedging. And hedging means buying assets with no counterparty risk. When the Strait of Hormuz gets threatened, it proves the promise of stable oil flow was wrong. The entire global economy runs on a promise that energy keeps moving. If that promise breaks, every financial assumption breaks with it. Supply chains depend on it. Currencies depend on it. Debt repayment depends on it. Remove that promise and the counterparty chains collapse everywhere. This is why central banks are buying record amounts of gold. They see the fragility. They understand counterparty risk better than anyone. They know that reserves held in another country's bonds are a promise, and they're reducing their exposure to promises. China, Russia, Turkey, India, Poland, Singapore, all buying gold, not because they think it will rally, because they know it requires no trust. In 2026, the counterparty collapse is accelerating, not because the system has already failed, because the cracks are becoming visible. And once people see the cracks, trust evaporates before the actual break. The pattern is always the same. First, trust holds. Everyone assumes counterparties will perform. Then, something breaks visibly. A bank, a currency, a defense system, an oil route. Then trust wavers. Some people start hedging. Then the hedging becomes a rush. Then the rush becomes a panic. Then the system freezes. Then promises get broken wholesale. We're somewhere between wavering trust and the rush right now. Gold at record highs is the wavering. When it goes parabolic, that's the rush. When governments start restricting gold exports or confiscating it, that's the panic. The freeze comes after, and the broken promises come last. The lesson from every prior collapse is simple. By the time the promises break, it's too late. Lehman creditors couldn't get out after the bankruptcy filing. Argentine depositors couldn't withdraw after the freeze. Lebanese citizens couldn't escape after the capital controls. The window to act is before the break, not after. Gold is the only major asset that closes that window slowly. Stocks can gap down 30% overnight. Bonds can default instantly. Banks can freeze accounts without warning. But gold moves in a market. You can see it rising. You can watch the trend. You have time to react. Not much time, but some. Right now, gold is telling you the counterparty risk is repricing. It's not screaming yet, but it's not whispering either. It's breaking through resistance levels that held for months. It's making new highs while everything else feels fragile. That's the signal. The market is quietly telling you that promises might not be enough this time. If you hold assets that depend on counterparties staying solvent, you are exposed. If the bank fails, your deposits are at risk. If the government defaults, your bonds are worthless. If the company collapses, your shares go to zero. Those are not theoretical risks in 2026. They are visible possibilities. The uncomfortable truth is that most wealth is stored in promises. And most people never think about what happens when the promiser can't deliver. They assume the system works. They trust the counterparty. They believe the promise until it breaks. And then they learn the lesson every generation learns. Promises are only as good as the ability to keep them. And in crisis, that ability vanishes. Gold makes no promises. It offers no yield. It pays no dividend. It generates no income. And that's exactly why it survives when everything else fails. Because survival doesn't require performance. It requires independence from counterparty risk. If this changed how you see your portfolio, share it. Because the next crisis will teach this lesson again. And most people will learn it too late.